Blast off.
Blast off. Okay.
And we're back. Once again, another beautiful week.
Another beautiful week is right.
Tell us what's going on in the
Cannot
world
complain.
today.
I wish I knew what was going on in the world. I'm trying to keep my focus on the price and not on what's going on. Because if
It is what we pay you for.
yeah, I tell you what, when we did the alert the other day, one of the things that made me nervous the most was how much positivity in the news I was hearing.
Right.
So earnings season so far has been really, really good. And one of the things Kramer was talking about the other night is how, like Apple, Facebook, like the big tech companies, a lot of them, the FANGs, that's what I was trying to think. The FANG companies, minus Netflix, he doesn't like Netflix, but the FANGs are doing, the earnings were spectacular. Facebook,
I know.
yeah.
If you take the end out of it, I was like, no, I'm not going to say that word.
Yeah, no. Yeah, no.
No.
So he doesn't like Netflix. That's fine. But all the other ones, the earnings were really, really good, which makes sense because it's still coming off the COVID thing. But the market, the stock market, didn't respond well, and so in fact, a lot of them went down.
Mm-hmm.
And so he's basically saying now is like the time to buy these companies because the earnings that they're putting in aren't being appreciated by the market.
Right.
And so therefore they're undervalued, and so now's the time to buy them. We'll see in a couple of months whether or not he was right.
Yeah.
But again, with going into the summer and the seasonality of things, the bias is definitely negative. And so he wasn't the only one. A lot of people are talking about how great the earnings are, and they are. It's just that it's not being reflected in the price, and that's the only thing that really matters to me.
Yeah.
Yeah,
exactly. I mean, the price is what we've got.
Yeah.
And if you buy into the idea of technical analysis, one of the principles of that is that price discounts everything else.
Right.
Meaning, it's another way of saying it's all built into there. And how does that work? Well, the price reflects supply and demand.
Yep. And
it's as simple as that. We don't care why.
Right. All right.
We don't care why it's reflecting it. It just is. So people like Kramer get paid to figure out why.
Yeah.
When we already see the what. That's what we're paying attention to.
Yeah, exactly.
We only care about what's happening, not why it's happening.
Yeah. So interesting. Yeah, I'm reading, like always, but filtering all that stuff through what price is actually doing.
Yeah,
so.
It's always curious to me though that like most of the fundamental folks that you see on CNBC and Bloomberg and whatnot. I know they know about Elliott Wave. Like we
sure.
They're all educated analysts and investors, and there's so very rarely a mention of the fact that we all kind of know we're going to hit a top, and they'll say that, but they won't. They don't really throw in the technical analysis part, right? They'll come up with reasons why. We were I shared an article with you early this morning about something similar where a fellow was saying very very respected investor, kind of fund manager, that he fully expects there to be a 30% drop, if not more, very soon. How soon? We don't know. It's basically the same thing you've been saying for months now. Yeah. It's coming. We just don't know when.
Yeah. I tell you what, this morning I woke up and I'm looking at Investors Business Daily, and they had shifted their confirmed market trend to market under pressure. And so it always makes me feel good when the alerts that we do inevitably are a day before something that IBD is going to do, because they wait until after the close. Yeah. And we can't wait till after the close. We got to do it before noon, right?
Yeah.
So whenever I get up the next morning and I'm looking at when IBD updates their, whether or not we're in a confirmed uptrend, market under pressure, or correction, it just
it's nice validation.
Validates for me. Yeah, it's validation for me.
What we got?
All right. So this week we're going to take a look at what's the difference between diversified and concentrated portfolios, and what does that mean in terms of TSP? It's very different than how people that invest in individual stocks and even ETFs look at diversification versus kind of concentrating. So for us, it's basically, if you're diversified, you're buying all the TSP funds, which is only 5 of them. So there's only so much diversifying within our realm of TSP that you can do. But we're going to kind of get into that. And then this idea of selling on a down day has been something I've wanted to talk about for a while. I got one chart that we'll just kind of pick through with the idea of the 2 rules, right? You have to have your trade-in by noon to get that day's closing price. So when you see on Facebook or wherever that, hey, you selling on a down day is a bad idea. So we're going to go through and look at some of these days and some of the tails on the candlestick on the intraday, and how would you know that you're selling on an up or a down day? Like, I just
at least at the point at which you would have to make that decision.
Yes,
which is
exactly,
by noon.
Right.
It's a whole different story if we could wait till closing.
Oh yeah, it'd be great if
we knew that was a down day.
It was a down day. If you don't know,
an update. You don't know that at 10:30, 11 o'clock in the morning.
Right.
You just you're just gonna use all the data you have.
You have to make a decision at the time, and TSP makes it difficult to use that as a methodology.
Yep.
Not buying on a down day, the concept of it, if you're doing swing trading or some of these other kind of methodologies, it makes a lot of sense. It's not that this idea doesn't make any sense. I just don't see how you apply it in terms of TSP.
In the context that we have, in the confines that we have.
And even actually the opposite is more interesting. Did you get in on an up day?
Mm-hmm.
Like, how do you know that today? Well, you can't know. Like, just like we're saying. All right. So the whole idea of doing the show on this came from one of our members, and so the question was, I was wondering if both CNS are doing well and above the moving averages, is it more advantageous to be in both equally or just one of them 100%? Seems like when you split them, you're setting yourself up for a good day in one being offset by a bad day in the other, and your gains will be less in the long haul. Thoughts? So that's where I thought that was a great question and something that we should kind of explore in a show. So because her question really is about diversification. So here's the quote. There is one other rule you ought to keep in mind, and that is to concentrate, not only in the Zen sense, right, concentration. Sweet are the uses of diversity, but only if you want to end up in the middle of an average. Okay? So if you diversify, it was the same thing kind of Warren Buffett quoted from a couple of weeks ago, right? He said something to the effect of diversification is only necessary if you're ignorant, basically, because you want to spend your time focusing on the few things. Well, one of the quotes from him about diversification, actually, that I chose not to use, was that he basically, his recommendation is 6 companies. If you buy 6 companies that you know really well, you're 6 is the number that he's come to that it makes the most sense. He's like, your seventh idea never makes you any money. It's going to hurt the other 6. So he's like, I generally don't do even the 6. He didn't put out an exact number in this piece I was reading, but he's like, I don't diversify. I mean, I know what I'm doing in the 3 or 4 companies that I am fully invested in, and I know when it's time to get in and when it's time to get out of those companies. And when he gets in and out, he buys and sells the whole company. He's not talking about buying a few shares.
That's a whole different version of getting in and getting out of the market. It's
completely different. But yeah, I mean, you could pull out the wisdom in all these people's ways of looking at the world. So anyway, that quote comes from this book. The author, Adam Smith, not to be confused with Adam Smith, the Scottish economist and philosopher, who is also known as the father of economics and the father of capitalism. So that's not the Adam Smith we're talking about. This Adam Smith comes from a book that was called The Money Game that came out, and actually was 1967. Was written by a guy named George Goodman under the pseudonym Adam Smith in order to keep his published articles about Wall Street anonymous. Goodman was quite a character. He was magna cum laude grad from Harvard, was editor of Harvard Crimson magazine at Harvard, was a Rhodes Scholar, Army Special Forces officer, turned financial author. His first book was The Money Game, was a #1 bestseller for a year, and it's another one of these classic Wall Street reads. According to Wikipedia, his personal style of presenting economic facts and data has been described as that of a witty, urbane dinner guest, a droll observer of human affairs, rather than a stodgy economics professor. Goodman pioneered a style of financial writing that made the language and concepts of Wall Street more understandable and accessible to the typical investor. It is definitely on my summer vacation reading list. And I might just start that this weekend, actually. All right. So if you go to Investopedia, if you want to look a little bit further into it, again, conventional wisdom, right? Most basic articles on personal finance advise investing in a diversified portfolio. I think that of all the conventional wisdom things, that's probably the one that gets beaten into our collective brains the most. Diversifying investments is touted as reducing both risk and volatility. While a diversified portfolio may lower your overall risk, it also reduces your potential capital gains, which in this case is not capital gains taxes, it's the actual gains that you can get from your portfolio. The more extensively diversified an investment portfolio, the more likely it is to mirror the performance of the overall market, which is exactly what Adam Smith, pseudonym, said in his quote. You're going to get the average if you diversify. Since many investors aim to beat the market, they may wish to revisit the issue of diversification versus concentration in their portfolio choices. While diversification is a good way to preserve wealth, concentration is often a better way to build a fortune. So, the question that we got that generated this whole thing was right on the money. If you diversify within the TSP funds, it seems like you are setting yourself up for increases in one day, in one fund, but decreases in the other fund, and you aren't better off in the long run. And yes, that's true. If you can pick the funds that are going up more than the other funds, right? That's the thing.
So you may be getting into this to later, but I kind of think of diversification with respect to TSP as that's why we are in indexes versus, large indexes versus like small indexes or individual securities,
stocks,
right?
Yeah.
Because the whole idea is that an index like the S&P 500 is way less volatile.
Yep.
Even though we might have what we call big up and down days, and relative to the market, individual market, no, that's not the case, right? So
exactly right.
That's kind of how I think that that is one of the the geniuses of the TSP is that they decided to do that, right? So it's balanced and it's not as volatile.
Right.
They kind of built in diversification.
Yes, actually, that is what we're gonna get to. It is built in. So again, diversification versus concentration within with respect to TSP, the C fund is the S&P 500, right? It tracks the S&P 500. So the top holdings as of December 31st, 2020, top 10 holdings in order for the C fund was Apple, Microsoft, Amazon, Facebook, Tesla, Google Class A shares, Google Class B shares, Berkshire Hathaway Class B shares, Johnson & Johnson, and JP Morgan. So the vast majority of that is big tech, Apple, Microsoft,
and that's
Amazon,
with
Facebook,
the C fund.
Tesla. C fund.
Okay.
That's the C fund. So as the
those are the driving forces on the S&P 500 right now.
Yes, right now
they're
definitely.
Leading. Okay.
Yep. And they're all big tech companies. So the S fund, for example, is not big tech. It's small tech. And so when people say, well, how come the NASDAQ is up but the S fund is down? Or even more, this is kind of a side note, but even more importantly, why is the Dow up and the S fund is down? So this is a total going off script here, but I've seen a lot of questions about that recently where people, for whatever reason, are seeing the S fund as the Dow. What in the financial world, when they say the Dow, they mean the Dow Jones Industrial Average.
Mm-hmm.
Okay,
not the same.
Dow Jones is a company. It's like BlackRock. BlackRock has a ton of different ETFs and products that you can buy and all that. Dow Jones is the same thing. Dow Jones is the company that does, does the Wall Street Journal. I mean, they do a whole lot of different things. But when people say the Dow, with respect to the stock market, they mean the Dow Jones Industrial Average. The S fund is the Dow Jones Total Completion Stock Market Index, right? Total completion is really the key. It's more small and mid cap, but it's the completion index. It actually completes the S&P 500. So really, it's most like the Wilshire 5000 index, which is the S&P 500, and then the other 4,500 that make up the Wilshire 5000. That's the S fund. Mm. It has nothing to do with the Dow Jones Industrial Average.
It just happens to have it in the description, the name.
It has it in the name, and it's got people thrown. Yeah, Yeah. I don't know how to answer it any better, and I don't know how to get rid of sort of the question about it. So we'll just keep talking about it and answering the questions, and there you go. Okay, S fund top holdings as of December 31st, 2020 was Square, Uber, Zoom, Twilio, Snap, NXP Semiconductors, Blackstone Group, Workday Inc., DocuSign, and Lululemon. So aside from the last couple, Blackstone Group, I have no idea. Workday, no idea what they do. DocuSign, obviously, it was booming because if you tried to buy or sell a house or do any other legal, paperwork, anything like that, it's all digital now because of COVID, right? So, and obviously Square, Uber, Zoom, Twilio, Snap, those are small tech companies relative to Apple and Amazon and all that. They're small tech companies that are driving the S fund, and they have been tanking for the past several months. I fund, we talked about before, is quite a bit different because it's the Europe, Asia, Far East Index, and their top holdings, Nestle chocolate is number one. So that tells you a lot. Is nothing. It's not tech. It's much more. It's actually much more biopharmaceutical than anything. But Nestle, Roche Holdings, Novartis, ASML Holding, LVMH Holding. I don't know what either of those are. Toyota Motor Company, Unilever, which is like soap and all that in Europe, right? AIA Group, SAP, and AstraZeneca. So it's a much different portfolio of things than there is in the C fund and the S fund. The F fund F and G funds don't really have holdings. I mean, they do, but the F fund has so many different variations of bonds and things that they don't even list it on the TSP website what their holdings are. And the G fund is the money market that only applies to us. So in terms of diversification, the C fund tracks the S&P 500 that has 500 stocks in it. It comes diversified, but within the confines of what is in the fund, right? The S fund has more stocks in it than the C fund, so theoretically it's more diversified, right? But for our purposes, diversification means, should I be only in the C, which is diversified in and of itself, or should I be in both the C and the S to get even more diversification? And so honestly, it's not really worth thinking about the underlying stocks in those indexes, because for our purposes, diversification means how much do I want to reallocate between the three stock funds, and how much do I want to use the C and the F, or the G and the F funds, So basically, to answer that, here's the thing. This goes back to 2002, and it's a chart of the C, S, and I. So the C is the black line, the S is the red line, and the I is the orange line. I'm not going to get into too much. Since the prices are all different, I don't want to misrepresent what the chart is saying. The overall idea I wanted to get across from this is that the C and the S here are going up at the same time the I is going up. Okay, that's really the important thing. Overall, all the stock funds go up together, right? And overall, they go down together. Okay, that's kind of the point. So in general, the GrowMyTSP concept is be fully invested in the stock funds when the overall market is going up, right? And you can see from there while the overall trend is going up, if you're evenly distributed between the 3 TSP stock funds, you are maximally diversified. Okay, so on any given day, you're not going to know whether the S fund goes up and the C fund goes down or whatever. But over time, all the stock funds tend to move up and down together. So if you want to be maximally diversified and you're playing the long game,
you'd be like 33, 33, 34,
right,
or whatever.
Which
that's
is
the math. Yeah,
that's the math. Which
Okay.
is generally why that's what our allocations are.
Yeah,
not always,
if
but
you
generally.
go look back historically
Yeah.
on our page where our historical allocations are, you'll see that pop up. And I think that if you would zoomed in on that, the chart you've got there,
Yep.
and I know you don't want to get in the weeds, but the takeaway is, well, the people would say, well, then why sometimes are you 50-50 or whatever?
Right.
Well, that's because if you zoom in, there are times when they're not going the same.
Right.
One's doing a little better than the other. But that is why we start here.
Yes.
And then go in.
And then go in.
Because what we see is, if, again, you wanted to be more passive than we are, less riskier than we are, which is way less riskier because we're
pretty conservative.
We're very conservative. Then that would be a way to play the game. 33, 33, 34, let it roll, right?
Yep, definitely.
And you're gonna do better than most ever will over a 30-year career, right? Because you just kind of you were in. Now you could do better. That's our point.
Yeah.
Right. That's the second part of the GrowMyTSP methodology is. Which I know you don't want to go all the way into that, but the second part is
don't lose money.
Get out.
Well,
get out. Don't lose money. When we see that coming. But that's a really good chart though, because hopefully the people that understood the question understand this chart. Whereas the diversification is built in. I think that's one way to start from. And if you truly want to be maximally diversified, as you put it, just evenly distribute between CS and I.
Right.
There you go.
Right.
Is that the best plan? We wouldn't think so, but it's a plan.
It's a plan, and we're gonna get into what it would look like if and how you would compare.
And that really wasn't her intent of that question either.
I'm getting a little bit deeper into the concept of her question, but the one kind of side note again, right here is where the I fund in 2003 diverged from the C and the S fund. So if you were in the government back then, the I fund absolutely crushed the C and the S fund. We talked about it, I don't know, probably a couple of months ago at this point, but the I fund in here made a whole bunch of TSP millionaires. And then the top hit in 2007, and the I fund took the biggest hit, and a lot of people lost quite a bit. So basically, just to point out that the C and the S are not always the best option. So don't count the I fund out yet. Okay. So if you wanted to figure out which of the 3 stock funds to be in, because it's all relative to the C fund, right? We're trying to diversify in the context of this is to try to figure out which either be fully distributed, evenly distributed between the 3 stock funds, or do I want to limit the number of stock funds I'm in to do better than the C fund? So everything going forward here, the next couple of charts, is going to be relative to the C fund, and this is the C fund. So from 2002, this is a monthly chart, and I just did closing price at this scale. Doing candlesticks isn't very useful, but we get the bottom here in 2003, right? Had a big run up. The tech crash, bottom in 2009, and we've been going straight up ever since. So that's what you're competing against. If you're trying to out diversify the C fund, this is a chart of what you're competing against. If you're the S fund, okay, this chart is the S fund relative to the C fund. So it's, again, the S fund started back here in 2006. It doesn't go back to 2002, but if you do a ratio of the monthly price of the S fund in the numerator and the monthly price of the C fund in the denominator from 2006 to present, this is the chart. So what that means is from 2006 to 2008 here, the C and the S were basically flat in terms of the ratio. From 2009 to 11, the S fund did way better than the C fund, right? If the angle of the chart is up, it means that whatever is in the numerator is doing better than whatever's in the denominator. Okay, so the chart isn't the way we usually use charts. This chart just plots out on a monthly basis essentially over under of the S versus the C. So from 2009 to 2011, the S fund clearly outperformed the C fund. And then you get some rolling here. And from 2014 to 2020, on average, the S fund did much worse than the C fund. Okay? So if you were in the C fund from 2014, right? If you're in the C fund from 2014 to 2020, you did better than you would have if you were in the S fund from 2014 to 2020. Then COVID happened. And as we know, the S fund is made up of the smaller tech companies that did really well during once the COVID crash started recovering, and you get this giant relative overvaluation, or not overvaluation, but over performance versus the C fund, right? So, and it goes along with what everybody sees in their TSP. If you were in the S fund, once the bottom was in after COVID, if you were in the S fund, you made a killing versus the C fund. Until the last couple of months. You got that. So the C fund has been outperforming the S fund by quite a bit. It doesn't mean the C fund has made huge gains, because it really hasn't. But relative to the S fund, it's been outperforming, right? So the I fund, like we said back here in the early 2000s, the I fund was crushing everything, hugely outperforming the C fund. But once it topped out there in 2007, the I fund has been consistently underperforming the C fund. Okay, at some point it's going to turn, because everything goes in cycles. And I think we talked about it a couple of months ago. If this is a bottom, it'll be great for us, because I'm really focused on that as a potential bottom.
And what we might have is a double bottom and then a bounce up.
Yeah. So basically, what I'm really looking at is, if you drew this trend line down, if we can get, back up here somewhere, we're in really good shape. We're getting in as close to the bottom on a relative basis as you can do.
Yeah, and again, back to your kind of original breakdown a little earlier on about what makes up those funds, the companies that do, it starts to make sense, right? And so you think about how after COVID, that's why the S fund, blew up. You talked about that, but now you start to see all the things that you listed that are in the I fund. Not that those things might start doing really well. It's just in compared to the C fund.
That's right.
Because the C fund it is what it is. We already described it, and those are two different things, right? So it makes sense that one might flatten out, or go down. But based on supply and demand, and the other one, again, it may not be a huge spike, but relative to the C fund, it would be, right? Yeah, that's kind of what you're trying to show.
Yes,
and it just makes sense. It's just like when we got out and in for COVID, it wasn't really about the companies that were in there; it was about the price.
Right, it was price.
The price reflected what was happening. Right, and so that's what's about to happen with the I fund.
Potentially, yeah. I mean, we'll see it.
It'll happen. We just don't know which way it's going to go. It'll be reflected in the price. We just don't know which way the price will be.
Yeah. You'll definitely see it in the chart, which is great. You don't have to worry about what the underlying companies are doing. You'll definitely see it in the chart.
I think that's kind of what I was trying to get to, and just not doing a very good job of it. But I when we start talking about the components of the C fund, the components of the S fund, the components of the I fund, what I don't want people to lose track of is we really don't pay a lot of attention to that.
Right.
This is an educational thing, so we want to kind of give you the context and let you understand the big picture. But at the end of the day, we don't really care. We don't really care what makes up the S fund or the I fund or this ETF or that ETF. We're looking at how it performs based on price action.
Right. Absolutely.
And it's nice to know all those things, and those help understand the why. Yeah. Because we're curious people.
Yep. Want to know why. Yep.
So, but at the end of the day, I would hope that the viewers' takeaway is that, okay, I understand it, but it doesn't matter.
Yeah. No, it doesn't matter. And then a recent potential change, right, is the I fund. So there's legislation right now. They're trying to add emerging markets basically to the I fund, and there's a huge to do about we don't want China as part of the thing. So
that's a policy and political decision, not a financial decision.
Yeah, absolutely. Yeah. And it will definitely affect the I fund. There will be different companies and different percentages of allocations within the I fund and all that. If you're an investor in the I fund, it will be huge for us.
Right.
Because emerging markets...
If you take a financial perspective and not a policy or political one, you would lean towards wanting emerging markets in there because there's a lot of people killing it in that area right now.
Yeah, emerging markets are great, and it's based on the big cycle going forward. It's there's a lot more volatility, but there's a lot more money to be made in emerging markets than the old sort of, not stagnant, but going forward, there's going to be a lot more money to be made in Africa and Asia, and, but we'll see. But at the end of the day, if whether or not they decide to allow those to redo the I fund like that, so we'll know the underlying political ideas of it and all that, and eventually they'll make a decision. And let's say they do restructure the I fund, then it won't matter. We're still just looking at the price chart. I think it's going to help price go up, but it doesn't matter. If it maybe doesn't, maybe it makes price go down. Who knows? Yeah. But it'll be reflected in the chart one way or the other.
Sure. Yeah.
Okay. Do you think that answers the question, like the gist of the?
I mean, we might have over-answered it.
But hopefully.
But I think it gets to the point. Not really knowing, exactly what they were looking for out of the question, other than the simple fact that, hey, why wouldn't you be in these, or why would you? Yeah. I mean, I think that answers the question. I don't know if we gave the advice as to where to be, which is what our intention is not to do that.
Yeah.
Right. We're not going to tell you should be spread between all three funds. We're not going to tell you should be 50S and 50C. None of that matters to us because we don't know what the market's doing. We have to look at the charts. We have to look at the price action.
Right.
And so we're not going to base it off of this idea of generic diversification.
Right.
We're going to base our decisions based on what is the price doing today.
So that's a good point. I rarely, if ever, I think, have I ever been 100% S, right? And we've been 100% S since April 1st. Mm. And it has not done well, which we can see in the chart if I zoomed it in a little bit. It has not done well relative to the C fund, right? But in the pattern of the chart of the S fund, while the C fund was continuing higher, the S fund had been developing this consolidation pattern that if it had gone to the upside, it would have been another huge rally higher. And I want to buy when the pattern shows the best possibility, right?
Yeah. Not just because it just happened to happen.
Yeah.
Right. Because that's not what we're looking at. I think the difference is if you pull up the S fund chart again, and when you see that massive kind of boom right there, there was no warning. Really,
right.
There was very little warning.
No,
it was very little warning, right?
Yeah.
But the takeaway is based on our methodology and technical analysis and all these things that we're always talking about. The way you would see that coming is you see a consolidation, and you're like, okay, well, let's let this play out.
Right.
Let's see where it goes. If the higher high or is a lower low, and if you catch it then you catch it. If you don't, you get out.
Yeah, you get out. Right.
Which is what we did.
Right. Right.
Yeah.
Okay. So this idea of selling on a down day, we did enough of an intro about it in the beginning, so let's just kind of go to it. Tuesday. This was Tuesday this week, and the C fund closed below its 10-day moving average, and intraday went way down below its 10-day moving average line, right? It's the first time that it had actually closed below the 10 days since back here in late March. Nope. Yes, 10-day, mid-March. And we had just come off this sort of sideways consolidation. You know, a couple of days ago we had a new all-time high there, just above 4,200. But for the most part, we've been flat since the 15th or so of April. And that consolidation ideally would have led to a move higher, right? What you want to see is the market consolidate sideways and then pop higher. In this case, it popped lower, and it went pretty significantly lower during the day before recovering and finishing only about a little more than 0.5% low for the day. But how would you know in the middle of the day whether or not it's going to be a down day? You know?
Yeah, you're not going to have any clue. And I don't know if you're going to point this out, but, you know, to reemphasize things we've talked about in other shows, if you see the 50-day moving average below there, how far that is from the 10-day, that is generally represents the risk you are at, because the last time it had support was at the 50-day. Right. That's a long drop. Right. So in the way we play the methodology, the way we play this game, our methodology would be get out. The risk is way too high that it's going to find its way all the way to the 50. Yeah. Now, it may not.
It may not.
It may not. But the likelihood, the probability, not possibility, the probability is high that it's getting ready to go down. Why would we wait and watch that happen? Right. When you can get out and see what it does.
Right. So that was a big piece of the alert that we put out. So the risk reward ratio on this chart, it's 4% down from 41.6466 down to the 50-day moving average at whatever that is, 40.1422. It's 4%. It's 4% from the price there down to the 50-day moving average. It's 1.5% up from where it is right now to 42.25, which would be a new all-time high. So the opportunity cost, right? If you look at that as sort of the positive risk, the opportunity cost is 1.5%. The downside risk is 4%. And you're going into the seasonality stuff of the summer, and this flat consolidation seemingly failed, and we had a big volume down day on Tuesday. So if I take everything into consideration, it's kind of a no-brainer.
Yeah.
You know, and people are going to say, yeah, but you know, I locked in a loss.
You're going to take the loss no matter what.
If you didn't get out of the market, you didn't quote unquote lock in your loss, but you're still in the position of the downside risk is still 4% versus the upside to get to a new all-time high is only 1.5%.
Right. Now, we talked about this before. We won't go into it long term, but this whole idea of locking in your gains and losses is not the same in a retirement account as it is in a brokerage account. So go back and watch past shows to kind of dig into that. We're writing an article about it right now that'll be up soon. It's just an important thing for people to grasp in a retirement account, that your retirement balance is what you need to watch. If it goes down, it goes down.
Right.
Right. That's just.
Why can't I? Let's see.
The pen doesn't like you.
Eraser. That's what I want. Okay. more interestingly is so the idea of getting out on a down day, okay, is getting back in. So if you don't want to get out on a down day, then theoretically you want to get out on an up day, right? So which one of these up days would you have gotten out on? And of course, then you'd have missed this whole move higher. Like, which would you have gotten out on that day? I mean, this is a breakout off the 50-day moving average. Would you have gotten out on that day? I mean, I wouldn't. That's the day I'm piling in. So it's just different ways to play the game. But so as you see the concept of it's bad to get out on a red day running around the internet, just understand exactly what they're talking about and think through it. And does it really make sense in the marathon, not the sprint?
Right. Because many times, what we know and it takes a lot of people that, again, when we're talking about retirement accounts, we're talking about TSP. Most of what you read and most of these kind of quips that you find out there are these little are based on brokerage accounts, stock trading at the individual stock level or individual investor level, not in an IRA, definitely not in the TSP or 401k. Those are very different instruments than what you don't normally hear people talking about IRAs, 401ks, and TSPs because it's boring in a sense, right? We're probably some of the few people that actually talk about it publicly, but CNBC's not going to, right? I mean, that's not the way they're going to talk about individual investors or institutional stocks, or in institutional investing in individual stocks. But it's a very different thing, and so when you take these kind of theories, thoughts, whatever you want to call them, they don't match up. They don't work. So, but that's all they got. Yeah. What we need is a whole lexicon is that the right word? Of terms that or
applied to 401ks, IRAs, TSP. Yeah.
And ours, the one that we've made, and we're going to stick with it, is don't lose money.
Don't lose money has to be number one.
Don't lose money.
I mean, if you're looking at this chart and you can't see that concept of don't lose money, right? We broke below the 10-day moving average for the first time in a couple of months, out of a flat base, which should have gone higher, and it didn't. Okay, we broke down below that 10-day moving average on big volume. The indicators had already rolled over, right? The indicators are leading price lower. The downside risk is 4% in here.
Yeah, I'm not going to lose 4% with all of those things telling me that the probability is high.
The probability is high that you're going to come down to the 50, and really the most important thing is if price got back up here to 42.25 and it's at new all-time highs, you get back in, and your opportunity cost was only 1.5%.
Right.
I mean, if you ran this thing in Vegas, you'd buy it all day, right?
Hopefully that got through to folks, because those are the really important takeaways there. It's especially important in understanding our methodology and why we do things the way we do. It's just the core principles of that. For sure. Why we would have gotten out there when a lot of people would have been like, I don't want to lock in my losses. We're about to take a lot more losses, and we don't want to lose our money.
You're potentially about to take a lot more losses, and if you don't, we'll know it within 1.5%. Mm-hmm. So,
let it play out.
All right.
Here we go.
So we are actually pre-recording this, and so I'm going to go over weekly charts. And so the last tick is the week through Tuesday. Wednesday, the market had already kind of was non-committal in the morning, and it's been going down throughout the day. So by the end of the week, it'll be interesting to see how this actually plays out. But as of right now, here's a 3-year weekly chart of the C Fund. Same kind of stuff we've been talking about. The red line, the blue line is the 10-week moving average, which roughly corresponds to the 50-day moving average. So you can see how far extended the C Fund is from the 10-week moving average line or the 50-day moving average line. in terms of the Elliott wave, I didn't do the chart with the channels in here this time, but depending on the count, this could be could this be a top? Sure. Have I thrown the towel in on this rally? No. It's just that the risk reward right now, as we're sitting here, the downside risk outweighs the upside potential gains, and so that's why I got out. It doesn't mean I'm getting out and I'm not watching the market, and I expected that we're going to see something like that. Okay. There's the C fund, 3-year weekly. We are on a weekly basis. We're a little bit overbought, which we could stay overbought for quite a while, but definitely once the RSI turns on a weekly basis, this is different from daily. The weekly trends are a lot more significant. So once the RSI ticks down a little bit on a weekly basis, MACD will roll over, and we'll start doing something like this, and price will do something like that. S fund. This is the pattern that if it breaks to the upside, we'll get another run higher. We talked about it last week. If it doesn't break to the upside, because right now we got a double top right here, where this high is actually lower than this high. And so we have this triangle. If it breaks to the upside, great. If it breaks to the downside, it's going to be ugly. Last week, the risk reward ratio was looking pretty good because we had several weeks in here where the market was going up along the 10-week moving average line, and we were looking pretty good. Then we get this reversal week last week, right? And then this week so far has been a down week. So we'll see. If the 10-week moving average line holds, that's great. If it doesn't hold, we're in a great position. If it does hold, and we get back above it's 2250 is the top, and we're not very far from that right now. So again, the same thing on the last chart. Our risk reward ratio is really good right now, and going into the summer seasonality, I'm happy to be where we are in the CNS or in the G and F funds. Okay. I fund, same kind of idea. Indicators are kind of non-committal. Non-committal, but as price has been rising, the indicators have not been rising to go along with it. So it's just the market risk is high. I don't know any other way to put it. F fund. So when we did the alert, we reallocated 50G, 50F. The F fund right here, we definitely put in a bottom. Whether or not that's the final bottom, who knows? But you got a pretty good A, B, C, and from a weekly perspective, we were talking about the Elliott wave 5 count, which was actually this piece in here. But when you pull it out to a longer perspective of weekly, you get more of like a 1, 2, 3. And if that's the case, it's a correction. We have a bottom in here, and we got at the beginning of a new rally here. As long as the price can stay above that 10-week moving average line, and then the line starts to curve up, and price can stay above it, we're gonna make money during the summer in the F fund if the stock funds continue lower. We shall see. Again, in the news, there's a lot going on. Janet Yellen came out yesterday and made some kind of statement about the need to increase interest rates. And she had made the statement apparently a day or two before, and it was recorded and then became public last night. And people kind of flipped out.
Mm-hmm.
And so anything about rates is what affects the F fund. So we'll see about going forward. But you got that. So if you can see the difference here, you got these indicators high and starting to trend lower, right? Versus the F fund, where they've bottomed and starting to trend higher. So ideally, that's where we're getting into is at the bottom of a new run higher. That's the idea behind it. And it'll be confirmed as long as we can stay above that 50-day or 10-week moving average line.
Yeah, and this we were just talking about this yesterday, where I keep talking about we've almost got our performance stuff up. We really do, and we were kind of rolling through all of it and looking at different things. And one of the things that I noticed right off was there was a few months in there last year where this kind of similar thing happened, where if you were in any of the other funds, L fund, stock funds, whatever, you took a loss.
Yep.
We were in the F fund,
yep,
and we got gains. They weren't massive gains because the F fund doesn't work like that, but they were gains.
Yep.
And when I'd rather take the gain than the loss.
Yep.
And so this, we've confirmed in the past historically that this works. And I think a lot of people get, kind of locked into this idea. Every once in a while, you get lucky. You were in the S fund, and it flew, sky high. But that's not normally how it works.
No, it doesn't work because the market doesn't give it to you, and it's not repeatable.
Right. That's really where I'm going with this. Is it's not repeatable. Whereas what we're looking at right now, what you just pointed out, has happened several times in the past few years, where we've taken advantage of the F fund, which most people wouldn't think to. Right? I mean, I didn't used to. Yeah. I don't know. Maybe I'm an anomaly, but most people don't pay much attention to the F fund.
People think the F fund works almost in inverse to the stock funds, and it's not
the same.
No.
If you look at a chart, it may kind of look like that, but it's not. But the key takeaway is to look at all five.
Yep,
that's really what we do. Look at the G fund.
Yeah,
so you're looking at four. Look at all four and do what the market tells you.
Yeah, if you can see, so the two big takeaways, I guess I would sort of put out about this show here in terms of volatility or diversification and where to reallocate. Timing is a bad word, but it's what the chart tells you. So
let's say trend is a better word.
Yeah, the trend. What the trend is telling you. So like in this case, in the case of the F fund here, we are quite possibly in the beginning of a new uptrend. Because we've just come off this pretty big correction here. There's more potential for this in this chart, especially given the indicators.
Higher probability.
Yeah. Than there is in any of these that are overvalued where the indicators are already topping and rolling over. So it doesn't mean it really has nothing to do with what my rate of return was since January 1st of this year. It's just a completely different way of looking at things.
We care what our rate of return is.
Sure.
But we're not looking at it.
No.
What we're looking at is the charts, and we're trying to maximize it as best we can while keeping the risk low. And at the end of the year, we'll see how that plays out. Right.
It's a marathon. It's not a sprint, like we always talk about. The one other thing I got a little bit mentally sidetracked there. So the F fund is in great shape in terms of the technical indicators and the pattern, right? It was the other thing also that I was looking at on the I fund, right? The ratio right now is at a place that I'm really watching for the same reasons. I'm looking for this chart pattern to give me a bottom so that I can reallocate into something that is in a new uptrend, as opposed to, maybe I can do it this way. Yeah, as opposed to something that is clearly topped out. So basically, to circle back to the original question that started the show, diversification. I mean, if you can look at the chart, and the charts give you one of the funds being low and moving up versus other funds being high and moving down, then yeah, you don't want to be diversified into the funds that are going down when you have an option to be in the funds that are going up, if that makes sense.
It does to me.
Yeah.
Hopefully it does to everybody else.
That's where I'm at.
Questions. All right, guys. As usual, we really enjoy the show. Hope you guys enjoy it. If you have questions, put them in the comments on Facebook, comments on YouTube. Subscribe to us on YouTube, and you get a notification when the video comes out. You can also do that on Facebook. We put it out on the Facebook group, Facebook page, and on YouTube, basically to get it as many places. It's also on the website if you go to the website. So watch it where you can and give us some feedback. We love having feedback, like having good feedback better than bad feedback, but we'll take either one.
It's all
right?
Fine.
Yeah, and what's really helpful is these questions, right? Because that gives us things that we can talk about that are relevant to the people that are watching.
Yep.
So if you have a question, I promise you there are 100 other people that have the same question. Share it with us. Hope you guys have a great week, and I think we're going to call it a day.
We're out.
You ready?
Peace.